Thank you all for joining. Today, we're going to talk about the future of the full spectrum of investing capital and about ESG, environmental, social, and corporate governance, and innovation and collaboration as both the private sector and philanthropic world engage in solutions to the massive and complex problems facing our natural resources, health, society, etc. Our panelists bring a multiplicity of experiences personally and professionally. The fact that they have not siloed those experiences allows us to have this really important conversation. I'm Sarah Tomolonius, the Vice President of Investor Relations at M13. M13 is a full-service venture engine focused on early-stage consumer technology companies. We enable our founding teams to execute better and more efficiently in order to mitigate time and capital risk, increase the magnitude and likelihood of portfolio company success, and drive stronger risk-adjusted returns to our investors. We believe strongly in being good stewards of capital to our stakeholders and in creating a virtuous circle within our broad ecosystem as we help create successful, durable businesses. I want to very much thank our partner and co-sponsor of this event, First Republic Bank. First Republic provides private banking, business banking, and private wealth management, including investment, trust, and brokerage services, specializing in exceptional relationship-based service. They are committed to responsiveness and action. Their dedicated tech and venture team, based in innovation hubs across the US, serves the needs of businesses at all stages of growth with resources, connections, and guidance. I am now pleased to introduce our speakers, but I have the unenviable task of reducing our multi-hyphenate panelists to a few sentences. In alphabetical order, Marcus Bullock is an entrepreneur, justice reform advocate, and two-time TED Talk speaker. After being released from prison in 2004, Marcus launched a construction business that grew to employ other returning citizens. He is the founder and CEO of Flickshop, known as the Instagram for Prisons, a software company that helps incarcerated people easily stay connected to their families and build community. Marcus is an inaugural cohort member of Techstars Anywhere 2018 and John Legend's Unlocked Futures Business Accelerators. Mark Tercek is a former investment banker and Goldman Sachs partner who then led the Nature Conservancy, the world's largest global conservation organization, for 12 years through 2019. He now continues to advise companies, startups, institutional investors, and NGOs on environmental and organizational strategies, as well as opportunities in impact investing. He is the author of the best-selling book, Nature's Fortune: How Business and Society Thrive by Investing in Nature. He has said, "I want to be able to look my kids in the eye and tell them I did all I could to leave the world a better place," a sentiment I know echoed by all of our panelists. And Dune Thorne is a partner and head of impact advisory and head of growth and strategy for Brown Advisory. Dune has worked with family offices and endowments and foundations for over 20 years, where her work has been focused at the intersection of investments and impact. Her personal impact focus has been on financial literacy for women and girls, and she founded a nonprofit called Invest in Girls that now serves over 5,000 girls across the country. Dune has been recognized as one of the top 40 women in wealth and as a young global leader by the World Economic Forum. So first of all, thank you again to our panelists. I want to broadly set the ESG stage, ask a few high-level questions, and then drill down into risk return and collaboration in the entire investment continuum. So as a society, right now we're reckoning with a climate crisis, a global pandemic, excruciating racial and economic injustice and inequality, social upheaval. It feels a lot like right now we're at a real inflection point for how investors, investment managers, and companies act on and incorporate ESG factors. In 2006, the year in which the UN first talked about ESG standards, 6.5 trillion of assets under management incorporated ESG, and now over 2,200 investment organizations representing over 85 trillion in AUM have signed up to the UN's 6 principles of responsible investing, pledging to incorporate ESG factors into their investment decision-making processes. Last year, stakeholder capitalism got spotlighted when the Business Roundtable of 180 CEOs of America's leading companies redefined the purpose of a corporation to benefit all stakeholders. And Ford Foundation President Darren Walker said, quote, "It is more critical than ever that businesses in the 21st century are focused on generating long-term value for all stakeholders, addressing the challenges we face, and resulting in mutual prosperity and sustainability for both business and society." 2 days ago, the Big Four accounting firms announced a new reporting framework for ESG. That came about through a partnership with the World Economic Forum and the International Business Council. But also this Tuesday, a study funded by the Ford Foundation found that during the pandemic, the Business Roundtable statement, quote, failed to deliver fundamental shifts in corporate purpose in a moment of grave crisis when enlightened purpose should be paramount. That's a reference to furloughs, lack of adequate protection for employees, and simultaneous shareholder dividends. Finally, we've had a movement to change the asset management industry by putting pressure on endowments, pension funds, and other limited partners to increase the diversity of their fund managers. Underrepresented groups managed only 1% of private equity and venture capital in 2019, though they have performed as well as or better than their industry peers. So that's a lot to chew on. Dune, I want to start with you. How have you seen the impact investing space evolve over the past 5 years?
Well, Sarah, thanks for having us. It's really nice to join you and Mark and Marcus today. And that's a sort of big question to start with, but I'll sort of jump in and get us started, and then Mark and Marcus can add to it. But we've seen incredible change. And I think the biggest part of it is that the idea of creating impact with your investments no longer means you're compromising returns. And that's so important. And I think it's a huge reason why we're seeing not only significant sort of interest increase from investors in terms of aligning their investments with their values and aligning investments with impact, but actually really seeing meaningful assets flowing into investments that have this alignment. So if we look at the evolution, frankly, over the last 30 years, but I think it's just been escalated in the past handful of years, I think we see this sort of incredible and fast-moving evolution from this idea of screening out, the idea that sustainable SRI, ESG, impact investing was about what you removed from your portfolio. And clearly there are many important aspects that are important to incorporate from the screening out. That's not where the real impact is being driven from. And so we've seen this evolution into the idea of integration, or what we like to call sustainable alpha, but how are the incorporation of E, S, and G all driving better returns in businesses? And that's where we're really seeing sort of the impact increase so meaningfully. And I think what's been particularly sort of noticed and important in the past 6 months in this time that you're in, the triple crisis that we're living through right now, is it's no longer just what you're investing in and how those companies are creating impact, but it's how the management teams and companies are building the culture that is going to make a meaningful difference for the future. And I am just drilling in that for one more minute, it really becomes the S, and the importance of inclusivity, diversity, how we all work together as teams to make better decisions. And we're seeing that, so no longer having the E in one silo and the S in another silo and a G in another silo, but the intersection points between them and the importance of inclusive management teams having a big difference in the companies that will make a meaningful difference for the future.
That's great. Mark and Marcus, do you have any comment on that?
Well, I might add, Dune's answer is a really good one, and she took a lot of important. As an environmentalist note, and one who was recently running a really big nonprofit, we found impact investing as a source of capital and as an approach really accelerated progress at the Nature Conservancy. So at Nature Conservancy, we were really big. We raised more than $700 million a year. They still do that. But protecting nature at scale is really capital intensive. So we said, well, wait a second. Maybe we can borrow money from investors to lever up our equity. In our case, that would be donor money, corporations do. And so then we did that. So so-called impact investors provided us debt-like capital to lever up our donor capital. So we had more capital, we had lower cost capital, but then another thing happened. We had a more business-like approach. And the business approach 101 isn't always exactly right. The NGO 101 approach isn't always exactly right. Bringing the two together, I think, is really exciting. So we had capital benefits, and then we had this business-like approach. And for us, that meant even greater accountability, reporting back to providers of capital, just like you would in the private sector. And there just continues to be more and more stuff along these lines, which I think is exciting as a way to unlock progress in addressing big societal challenges. But then for investors, you have more activity now. You can be a classic old-fashioned investor, You can be a donor to charities, or you can bring those skill sets and some of your capital together and see if 1 + 1 can be worth much more than 2. And I think it can be.
And Mark, I have to chime in as you describe some of the great work you're doing at that intersection, that one of your investments, the Cumberland Forest Project, was recently named the Sustainable Impact Fund of the Year in 2020. So it's such an example of the great work in this space. So kudos to you for that incredible work and your team.
Yeah, give the team the credit. I've moved on, of course, but it's a great example of what we're talking about.
So, so this is great. We're certainly going to talk about kind of the intersections of blending for-profit capital and philanthropy for impact. I'm wondering if, as you look across all asset classes, are there sort of certain qualities of particular asset classes that make them more uniquely well-suited to creating positive solutions that lead to really seismic shifts for people in the environment? I mean, I'm biased, I'm sitting at M13, so I certainly wonder if venture capital has that edge. You know, how do you think about that?
You know, I'll just say quickly, I do think venture capital has one kind of important edge. When I spend time with venture capitalists, I'm always impressed by how they want to solve big problems, because of course, that's a way to find big business opportunities. And then they're relentless, like, what is the best approach? And even when venture capitalists think they have the right approach, they don't just presume that will be the case forever. They're continually monitoring, getting rid of stuff that doesn't work, adding stuff that will. When we turn our attention to bigger companies, and it's dangerous to generalize, and there are some great leading companies, but I think for the big companies in the world, they could be more ambitious. So it's great. They've made a lot of progress thanks to the pressure of ESG and other factors. Companies have mostly stopped doing bad things to some large degree, and they're doing more good things. But I'd like to push them to be really ambitious at going after the world's biggest challenges. And that's where investors come in. Investors are owners of these companies, and I don't think you should relax. Investors should pound the table and push CEOs and management teams to be even more ambitious about addressing challenges. And I can offer specific examples if you'd like a little bit later.
Okay, great. I wonder, sort of, in my preamble, I started by talking about, you know, largely big public companies, and ESG investors have sort of hit on or sort of pushed ESG on the big companies, and then it went to private equity, and now it's you know, venture capital is focusing on ESG. Do you think that there are you know, because the sort of ESG movement started sort of higher up, do you think there are particular things that, you know, where ESG could be better, maybe if it had started on the venture end? And also, I wonder, I mean, venture is really, of course, the genesis of these companies that then later become big corporations. So just thinking about the way in which venture could sort of harness ESG in a better way that could trickle up as opposed to trickle down, and sort of leave it open to the group.
Well, as an investor who invests across all asset classes, you know, you think about impact really can be had in every asset class. There's incredible impact on the fixed income and debt side in terms of specific projects that can be funded, you know, some of which Mark was describing. There's, I think, a lot in the public equity side that's often misunderstood, that in terms of shareholder advocacy and shareholder engagement and engagement with management teams, and clearly so many more public companies also leaning into innovation in the impact space. But if there's one asset class that we'd say you can have the most impact in, it would be in venture. You're in a space where it's early stage innovation is happening. Bigger risks are being taken by companies that have big visions to make incredible change. And so we look at just the possibilities in the venture space to have very significant and meaningful impact is the one asset class that we'd say has the potential for the highest impact. And the other piece I'd add is, particularly as we're thinking about the how, and not only impact in the solutions from these companies, but in the impact in the teams you're funding and how that's going to change the investment landscape, that when you're investing in venture, you're seeding an initial team that's being built from day one. And that team can be built with a more diverse group of founders. It can be building a culture and the way the team works together to build a company and make decisions. So you're getting the opportunity to not only seed innovation in the first phase of growth, but you're also getting the opportunity to be funding and building a team that can look very different than the CEOs of public companies today, and I think there's really significant impact in doing that. But it'd be great to hear from Marcus on the other side in terms of being funded by venture capital.
It's a perfect segue, Marcus. I was going to say, you have an incredible personal brand, and at M13 we always say there's no asset class in which brand is more important than in venture. And of course, there's a current movement towards trying to make inclusivity and diversity happen, or happen more in VC. And yet, you told me you've pitched to the gamut of sort of Silicon Valley VC firms. It's been impossible to raise $1 million round. I mean, I think for our audience, contextually, it's important to know that in 2019 there were 13,000 VC deals done in the U.S. Over half of the rounds were raised at $1 million plus. So I'd love to, to hear your background, and also how do you think change is truly going to happen when you, as a founder in your company, have all of these assets, and yet you still can't get access or more access to VC capital?
Yeah, absolutely. Thank you for including me in this conversation. I mean, I think that for so long, these kinds of conversations existed without having the voice to come from our side to not only add a little bit of perspective and color to the conversation, but also to be able to get, create those table talk conversations that are going to happen as a result of this panel. So thank you for including me here. I mean, we understand, to give context before I even jump into that, the question around, what the journey has been like for us and what it took in order for us to be able to begin opening and raising up our seed round, is to be able to give context for what our company does. So the company Flickshop, we build a technology that helps keep families connected to their incarcerated loved ones. Our users, which are family members or businesses and nonprofit organizations, they're able to leverage our tech to take a picture, add some quick text, press send, and for 99 cents, we print that picture and text on a real tangible postcard, and we ship it to any person in any prison or jail or immigration facility anywhere in the country, because there's no internet there. And we want to be able to make sure that we are being intentional about building scalable technologies that allow for not only the successful reentry for people that are coming out of prison, but to be able to have a meaningful, humane life while they're there. And so I think that our company, falls in the S category of the ESG relationship. And we've had an interesting time, lining up the impact of our work, and also articulating the size of the market. I think that's one of the biggest barriers, especially when talking to VCs, because the majority of them, they either don't have the right analysts that are looking at investments like ours, and what the founder looks like. Dune kind of sort of alluded to that, or either they're so disconnected from this issue that their preconceived ideas about the impact that we can create typically gets overshadowed by the parts of the conversation that point to how massive our bottom lines can grow to be as well. I think that what's really interesting about this is that I've learned to go deeper with potential partners or investors, and give them opportunity to allow their businesses or their teams to experience the impact of our technology by scheduling team events that are packed with education and engagement from me and our technologies. And two, to go a step further and really deep dive around their focus in allocating investments before I ever even send the email. Like what is this company or this investor looking for in their portfolio that allow me to be able to rank higher up on their scoring charts, right? I want to learn more about their previous cascading impact strategies that they've invested in that are designed to tell an impact story with the communities that typically have a different set of metrics. I mean, it's like, in just to pinpoint some of those, drop a pin in it, like some of those metrics on Flickshop side is the amount of families supported by Flickshop, the future earnings of returning citizens that have real employment and safe housing as a result of the connections that were made with Flickshop, or even the reduction of recidivism rates in areas that are highly targeted by our machine learning ads. Those are all ways that, demonstrable ways that we can help determine impact that may not have what looks like direct alignment with that investor. Now, this doesn't mean that the Flickshop is misaligned with the goals of the investor, or that Flickshop doesn't have a strong revenue strategy. It means that the investor has an opportunity to assist in ways that they're more meaningful and impactful for the actual company, allowing us to continue to keep growing and scaling. Now, along our journey, when I walk into the room, and I don't typically look like the face of the entrepreneur that most VCs will come engage with, because they're typically talking to people that went to their children's school, or people that live in their neighborhood, or the folks that they went to Dartmouth with, or Wharton's business school, and then they meet me that has a very different background than the majority of the founders that will come into their offices. We have to figure out ways to be able to bring this new investor in and allow them to not have some of the same barriers that we had. And me going into the White House and having the president of the United States introducing our company and the impact that we had, and we still can't raise a single, $1 million seed round. We've seen this happen in other sectors, like sports, and then folks like LeBron and managers like Rich Paul came in and completely disrupted that. We've seen it happen in music, where hip hop completely came in and created a new culture, and we even seen it happen in Hollywood. And so I want to be able to see that the tech sectors and the CSR spaces become no different, and we have an opportunity to make a change that creates a better environment for all of us. I've been blessed to be able to have folks like Dune, who helped us put together a syndicate to open up our seed round, and just that one opportunity that Dune helped created another waterfall of other potential investors that wanted to say, oh, wait a minute, Dune has completely de-risked Marcus and Flickshop as an investment, and now we can say, okay, now we're ready to have a talk about impact of what you're doing, because someone else has said that the bottom line and the revenue is taken care of. Now we can think about other reasons to invest.
I think that's great, and I definitely want to talk about risk. Before we talk about that, I'd like to hear a little bit more from you, Marcus. When you ran a business for 10 years, you knew about debt financing, but you hadn't heard of venture capital. So what are your thoughts on how we kind of, right, how do we get this knowledge that there is this capital source, getting the money from the capital source to the entrepreneurs as another hurdle. But how do we get entrepreneurs who have great ideas, but not sort of access or understanding that venture capital is even out there, to that knowledge?
Yeah, I mean, Sarah, do you know how mind blown I was when I met the first entrepreneur that said, hey, I just raised $2 million from a group of high net worth individuals that's going to help me grow my business? And I'm like, wait a minute, what in the what? What am I doing wrong? Because I thought that the only way to grow a business is via revenue. Right? I'm like, this is no other company has done it outside of revenue, and maybe some debt financing, right? I mean, I swiped a bunch of credit cards and took out some loans some short-term loans in order to be able to continue to maintain Flickshop's growth during our big growth spurt seasons. But when I learned about equity financing, I'm like, I am completely doing this wrong. Now, interestingly enough, over the journey, I've learned that maybe I was doing it right, because it allowed me to learn about my business in ways that others didn't have the opportunity to. And it created some sense of grit and resiliency along the journey that's helping to transform me as the CEO into this monster that goes out and can attack the market without, allowing the barriers to be able to rattle me. But I think that it was interesting, to see that there was a massive, a big group of people who understood what this access looked like as they continue to grow these kinds of businesses. We give access by investing in people like me. To answer your question, how do you give access to folks? Like, invest in folks like me. There's a cultural gap in this space, and studies indicate that you can't be what you can't see. When you invest in real solutions and founders like me, you tear down some of those racial or other stigmatized barriers brick by brick. And just as VCs have historically invested in founders that went to school with them, like I talked about before, and we've seen this happen before in other areas, right? Like, we knew that when we started investing in folks out in Silicon Valley, because they went to war schools, or we saw folks saying investing in these brand new innovative technologies, like, hey, look, we didn't have a bunch of panels trying to figure out how to make it happen. What we did was we wrote the check, and then we said, let's gamble on it and see what happens. What ended up happening was we had massive innovations, and now we're seeing innovations continue to stale, and we're trying to figure out, how do we solve this problem? Well, let me tell you, invest in people look like me. There isn't a big secret. Write a check.
I might add to that, Marcus. In the environmental space, at first glance, you might think, well, we have a lot of success working with venture capitalists addressing environmental challenges. And in many respects, that's true. But when we think about things like environmental justice, or how we can have environmental interventions in the inner city, way behind. And I think a lot of it is cultural. So we haven't, how did you put it? You can't see. So you have a homogeneous group of very well-intentioned people doing very good things, but because the group is homogeneous, there are huge opportunities that we've missed and have a really urgent need to play catch up on now. That's another place where investors can make a difference at any level. You can push startups or big companies or NGOs, we need them all, to broaden their horizon and tackle some of these challenges and work with communities that they really haven't been engaging with yet. I think it's really urgent.
Is this a conversation about risk? And do we need to redefine how we're thinking about risk as we invest in sort of new and different, different looking entrepreneurs or different entrepreneurs with different backgrounds?
Mm-hmm. I would say risk is absolutely at the heart of it. And if you take risk and like, what is risk, right? Risk is risk is the framework, that you might use to say when you can't fully understand something, right? How do you create a framework to evaluate it? And we sort of say, is it high risk or is it low risk? And so in venture investing, I mean, risk is at the heart of it, right? These are in many cases, new markets are being defined that don't have, you don't know that market yet. The market is being defined and evolving as the company is growing, right? You have new innovations in technologies that you don't know if they'll work yet. So there's risk around that. And there's clearly risk around the team. Has the team worked together before? Has this founder built a company? Has had an exit? So there's risk on all these fronts. And what I find so interesting around impact is actually one of the ways you make significant impact is to take some risks. If you try and avoid all risks, it's like risk and return go hand in hand. The greatest impact comes when you take meaningful risk and you figure out how to find those frameworks that help you get comfortable with it. And, I look at, Marcus and my relationship and the decision to invest in Flickshop. It took us longer to get to know one another and build the relationship. We didn't go to the same schools. We didn't have, mutual friends in common. There weren't 3 reference calls I could make to kind of learn about Marcus like many other companies we've invested in. But we took that time and spent a year getting to know each other, getting to work together. So the way I got over that risk, right, was through time and through work together and conversations together and taking that time to because I couldn't do some of the other things I typically do to due diligence on a founder of a company. And so I think we just have to reframe in many ways to think about risk. I think what we also hear in many venture spaces, there's a huge opportunity to create impact in terms of products and solutions that are targeting minority communities and groups, right? Like you look at some, whether it's Walker and Company or, companies that are targeting Black and brown population, that is a meaningful growth demographic in our country right now. And I think so many early stage investors will say, well, I just don't know that market. And since I don't know it, it's too risky to invest in. But in fact, it's a really exciting market that we need to learn about. So we need to find the ways to educate ourselves and sort of unlock that opportunity. Because if we don't take those risks, we're not going to have the impact, both of the companies that are going to make a meaningful difference for those Black and brown consumers in our country, or have a difference in changing the landscape of company founders and management teams that we're investing behind. So I look at like the impact's going to come from the risk, and that's what's so exciting about the time we're in right now.
Hey, Dune, I want to ask you a follow-up question on that. Are you able to identify what the triggers are that will get you to the point of comfortability during those kinds of risk mitigation calls?
Gosh, there's a lot of layers to that, but that's, what you're ultimately trying to do, right, when you're evaluating a company. And I really should turn to the M13 team on this, because you guys are the experts in this diligence process. And this, I don't have the same expertise as M13, but you're ultimately trying to look at what is the company's journey going to be, right? And how is that company going to get to profitability? But you're also, you're looking at different paths, right? That there's often more than one path. So understanding what the different paths could be, and what are the questions you need to answer to have certain levels of probability, right? That a technology will work, or a market will mature and evolve, or a certain consumer will make a certain consumer buying choice. So I look at it as like there's many decision points along the way, and you're never going to get them all right, but you want to understand kind of what the different optionality is for a business or company along the way. But Sarah may have some better thoughts on that than I do, or Mark as well.
Yeah, I mean, certainly we think about the sort of changing consumer behaviors that are undergirding solutions that will need to be provided and things like that. And we think about it over a longer period of time, right? Of course, there's been an acceleration, a catalyzation of everything, a lot of those trends and themes, certainly through the pandemic. And so it's really looking sort of to the longer term opportunities. Mark, I leave the question open to you as well. I mean, do you have thoughts on this and on risk and assessing risk? And I'll punt for a minute and ask, are there interesting partnerships where philanthropic capital can come in and take some of this risk to move the needle faster?
Well, what should I add? Yes, you have to be attentive to risk in all circumstances, of course. You can take a lot of risk. You just have to identify it as accurately as possible so that everybody knows what to expect and capital is priced accordingly. I think a big problem when we follow up on Marcus's challenge is more the makeup of the team. So again, I'm sitting in the more narrowly defined environmental space. It's a heroic field of really great people who've devoted their life to make the world better, but it's a very homogeneous group of people. Internationally, less so, but still rather homogeneous. And then when we work with the private sector environmentalists, and again, there's a lot to be proud of there, it's again a rather homogeneous group. And so then I think as a result is and there's so much capital. So the capital providers are searching for places to put it, but there's a whole field of opportunity that I think is missed because the right people aren't on the team to help identify the opportunity or figure it out quickly, as Dune was beginning to say. So, we're talking about ESG, and the S part is supposed to include diversity. And I think this discussion underscores how important and urgent it is that all of the different types of organizations here prioritize making progress there. By the way, I'm very confident it will lead to better outcomes. Like if you're a venture capitalist, you'll have more exciting companies to invest in. If you're an environmental NGO, you'll have new opportunities for big wins and an opportunity to grow your constituency. It is, I think, one of those win-win things, but you need the right team to pursue it with confidence.
I just want to say to our attendees, go ahead if you have a question, put it in the chat function. I have questions for days, so I'm happy to continue asking questions. But if any of our panelists have it, just submit through the chat. Certainly, diversity, equity, and inclusivity are big factors. They're incredibly important. I'm wondering, as we try to kind of accelerate this move towards investing in, lots of different people, more people sort of, I'm thinking about in Q4 of last year, Lenox Park brought about their diversity impact score, which came to help asset owners evaluate the diversity impact of their portfolios, by which they benchmark their D&I efforts versus their peers based off of different components of gender and ethnic diversity. And this is something that's been adopted recently immediately by New York State Common, CalPERS, Greenspring. How much do investors, who has a voice in this change to creating a more sort of diverse and inclusive world, as you think about investing in asset management, who has a voice and whose voices are sort of the loudest to move this along?
I would say providers of capital. Providers of capital have a lot of clout and they don't use it as fully as they should. So if you're a capital provider, an investor, or in the nonprofit world, a donor, you have more clout than you're probably fully utilizing. Utilize it.
I think that's really, I just second that, Mark, that is a way we create impact, is by raising the questions, pushing, whether it's funds you're invested in or companies you're invested in. I mean, this is relevant on the credit side. This is relevant in public equities around shareholder engagement and the way you're voting proxies, and it's relevant as a private investor. And it's relevant as a philanthropist, too, when you're making grants and philanthropic gifts, right? I mean, you are in a position to be asking the questions that are pushing leadership teams to think differently. And I look at it from, being a member of our, executive team here at Brown, that when our clients ask us those tough questions, it forces us to have really important conversations internally. And that pushes us as a firm to keep getting better and better. And these are issues we care a lot about and we think a lot about, but there's always room to do better. And so I just don't stop asking the questions and pushing as an investor.
Mark, for you, I'm wondering how much, I mean, really for all of you, but in particular, Mark, I'd love for you to talk about kind of collaboration between different types of asset classes or along the sort of full spectrum of investing. When you were at the Nature Conservancy, obviously they're known for their very intense focus on collaboration to benefit people and nature. I'd love for you to talk a little bit about the case study of the Nature Conservancy's partnership with RRG to raise a fund for business returns and conservation outcomes, and sort of what the genesis of that was, and how much of that was an investor-led effort.
Yeah, no, thank you for asking. So it's kind of similar to the earlier discussion. More collaboration is another really good thing. And in this case, I think it's pretty easy to do. So yeah, the Nature Conservancy always was famous for collaborating. That meant like working with the private sector or not being too partisan and working on both sides of the aisle and the hill, things like that. But we decided to take it to another level. So we were doing impact, for example, we were doing impact deals on our own and raising investor capital. But it took so long, and providers of capital were a little bit skeptical because they said, look, Nature Conservancy, you're great at what you do, but you've never really been in the business of raising a fund and returning capital with a return to investors. So then it finally dawned on us, why don't we partner? And then while I was still there, we decided to partner with RRG, Renewable Resources Group, a private equity fund. And we are a GP and an LP, TNC. So it's very unusual for an NGO to do this. The fund's goal is to buy ag land in the West and in Latin America, change water practices so that economic value is generated and conservation value is also generated. And it was a winning team. So then RRG and TNC together raised $1 billion pretty quickly. Now, it's too early to declare success. Of course, that capital has to be deployed and the returns have to be generated, but I'd be very optimistic. We did another thing like that with Techstars. We started our own tech accelerator, but this was a tech accelerator looking just like all the other tech accelerators, except focused exclusively on TNC's conservation priorities. And one reason was that would be an opportunity to work with new people, new ideas, new sources of capital. But another motive for me was to infuse into TNC some of that startup venture spirit, that can-do, I'm in a hurry spirit. And it was great. So I actually think there's no limit to what can be accomplished through collaboration. And so that's another question to ask yourself, whether you're an investor, a donor, a corporate manager, an NGO manager, take whatever challenge you're trying to address. Should I ask for some help and see if there's a partner? Sometimes at first it feels like it slows you down because there's some discussion, et cetera. But then it seems to me, once you figure all that out and get straight about your goals, then progress really accelerates. So I think collaboration is underrated. And in the environmental field, I'm quite confident we need much more of it to achieve our goals.
It feels like there's kind of a fully virtuous circle. I mean, I think, Marcus, you from being an entrepreneur, my guess is that, or I guess the question is, have you worked with nonprofits?
Yes, I mean, we work with tons of nonprofits and NGOs that want to figure out ways to be able to get their core messaging back to people inside of these sales. Other organizations or businesses, they leverage our technology in order to be able to just share a moment of empathy, whether it be just saying, hey, we want to help uplift your spirit while you're sitting there. We know that 95% of the people that are sitting in prisons are going to come home one day. 600,000 of them come home every single year. And so, bring that one shared announcement that says, hey, with our company, everyone at our team is thinking about you. And we're saying, hey, we are fair chance hirers, or hey, we believe that you're going to come home and just do something positive, amazing with your life. I mean, it has been a big foundation of what it is that we want to build over at Flickshop. I'm excited to see what the future of this kind of support is going to look like.
Seems interesting.
Can I just add just one piece on the partnerships with nonprofits, because I just think this is such an important point, is that I think to Mark, like leading on to Mark's point around, how nonprofits and typical investment capital are coming together, is that it's also, you think about it as layers in the capital stack. And I think there's some really exciting, I mean, Mark's been involved with a number of them, but just for those who aren't as familiar, where grant capital is coming in and de-risking an investment for what we'd say is a more traditional and return-focused capital. And we're seeing that in a number of cases where, in the most basic way, where grant capital is frankly covering the additional cost of the structuring of a more complex structure, so that the investor that's return-focused doesn't have that fee burden, that particularly as it's a smaller fund, a smaller amount of capital, where the cost of the structure could be significant, the grant capital is coming in to support that. And you think about the impact of that grant, if the impact of covering the fees for the structuring is enabling, investment capital to come in and really leverage the impact, it's really meaningful what you're doing with that grant. And so we're seeing those partnerships in a number of cases where philanthropic capital and then return-focused investment capital are coming in together. And I think that's really exciting. If I just think about the future and where there's opportunity for impact, I think we're going to see more and more of that.
Yeah, what's interesting, Dune, I mean, as I think about what we did over at Flickshop, I mean, we received, when we had the opportunity to receive the non-dilutive grant from the New Profit, which is another venture philanthropy organization. I mean, and as a relationship with John Legend, John Legend, he was using the Flickshop app. He saw the importance and value of it in connecting with his own family, and wanted to figure out ways to be able to contribute back into this space, and partner with Bank of America and their ESG departments to be able to build a fund that allowed them to be able to invest in 8 entrepreneurs that had criminal records. I was one of those entrepreneurs. We received a $50,000 non-dilutive investment that allowed us to be able to build the Flickshop Angels product that created a space for families that didn't have someone incarcerated to be able to support children with incarcerated parents. Now, what that did for us, one is, massive impact, as you must imagine, right? I mean, being able to connect so many families and allowing them to be able to send selfies to mom and dad completely for free, which is huge. But it also contributed to our bottom line, allowing us to be able to hit revenue thresholds that made us a more of an attractive investment for tech stars to come in and then write us an additional follow-on check. And after that, one investment from New Profit and John Legend, that now later on allowed us to be able to snowball, and then eventually, we were able to meet some of our friends like doing that came with the syndicate. So it shows that how, and again, this is combined with the aforementioned debt financing that we had ever. So building that capital stack for us was integral to the place where we can get to a point where a VC would be willing to consider us.
The conversation between all of these, between what we thought of as a spectrum that I think before was sort of compartmentalized, and having discussions between all of these and an understanding of the opportunities in this space, seems really like the forward-looking way. I mean, the way that things should be, and the way that it sounds like the momentum is going. Recognizing the little bit of time we have left, we have one question that I'll put out to the group. The person has a question about the timeline of an exit opportunity for a company focused on ESG. They say, by nature, sustainable companies may have slower growth trajectories. I'd leave that to the group to opine on. And in many cases, such as that, how does that relate to the tension that most venture capital is time-bound to a specific time frame, for example, a 10-year fund life?
I'm happy to start off on that. I'm sure we could sit and have a good, healthy conversation about whether, an ESG-focused company has a longer time horizon. I don't think I would necessarily say there's a higher correlation there, because I think there are, companies that in the ESG space that, frankly, this move and focus on ESG is just escalating sort of stickiness of consumer and market growth and growth. And I think in many ways, ESG is, the wind behind the sails for many businesses that are speeding up time horizon. But I would say that, and Mark, you probably have a good sense of this from some of the environmental focus, particularly on the technology side. I'd say tough technology and really big, challenges to solve in the world, whether it's, clean water systems or, the major environmental direction change that we need to make. These are tough, big problems that we're going to require, tough technology to solve. And oftentimes there is a longer time horizon there. You think about what's happening in the battery space. We're invested in a battery company, Form Energy, that, that is a 20-year time horizon company. And so it has limited the number of venture firms that they can really look at as potential investors, because their time horizon is beyond the time horizon of most funds. It doesn't mean there couldn't be an exit event sooner, but it just raises, to your point, a different set of questions. And so we are seeing many funds have longer time horizons, which I just think is an important trend to notice, that we're seeing sort of extension in the fund term. Which I just think goes along with that question, that I think it's a really good, because you want to make sure the time horizon of the capital is aligned with the, the horizon of the time needed to really get to that meaningful impact.
Yeah, I agree with Dune. I would just add, capital is not scarce today. Capital is surplus. What is scarce are solutions to these huge societal challenges. So if you're a capital provider, that's where you, I think, will likely find some of your best opportunities, solving big problems. It's probably true that some of these big problems take some time to solve. But, there's a lot of stuff out there that is well-funded, things like Uber, where it looks to me like it's going to take them a long time to figure out how to, be a profitable company. So I think investors have figured out that timeframes, et cetera, are less the driver. What's scarce right now is not capital. It's not financial engineering ideas. We've been through all that. What's scarce today is what are the solutions or strategies to address these big societal problems? Like one I spend a lot of time on is climate change. And right this minute, we face some huge problems. So I think if you have that orientation as an investor, you're going to likely find your way to then some pretty good opportunities.
We have more questions. Unfortunately, we're out of time. I knew we were going to stuff a lot in as much as we possibly could, and I'm so appreciative. Dune, Marcus, and Mark, thank you so much for getting on this panel and sharing your insights and perspectives with us. This is certainly not a conversation in isolation, and so look very much forward to continuing to speak with all of you. And thank you to all of our attendees. Thank you again to First Republic Bank for co-sponsoring with M13.
Thanks, everybody.
Thank you for having us, Sarah, and the M13 team.
Thank you, guys.
Bye-bye.
Bye.